and gentlemen, if I may have your attention, please. We want to start with our panel. As tonight we have the opportunity to hear the insight from three experts of the mining industry who cover three different, or really quite different commodities, as you have seen already here on those videos. And just to give you an idea, on the first video with Victoria Gold, you have seen what effort it is for 0.8 grams gold per ton. And the company is making money. That's a matter of organization and real professionalism. So that's really outstanding. So first of all, George Paspalas, President and CEO of MAG.TO, please come up to the stage. You want to take the wine with you?
No.
Okay. Hey, George.
How are you, buddy?
Take care. Please have a seat.
The green's better than the red pants, right?
I know.
Yeah. Where do you want me to sit?
Oh, where you want. Here,
I'll
fine.
sit.
That's good. Oh, the red one, we wanted to prevent suicide.
I know.
Yeah, exactly. Then we have John McConnell, President and CEO of Victoria Gold. John, where are you? Here you are.
Johnny Roy.
Any particular place?
There you go,
take
mate.
This one here, that's fine. And then for the first time with us on stage, my friend Scott Melby, Uranium Royalty and URC. And as I said, unbelievable, who would have thought that in good old Switzerland, a uranium company on the stage. I love it. That is great. Yeah, thank you very much.
Scotty boy.
So, need to see you guys. All right. Shoes are for you, George.
I can't
love
beat
them.
that.
Yeah, ladies and gentlemen, so we want to get a bit of an insight into your companies, of course, and discuss some actual themes. George, I want to start with you. Over the past year, your company has transitioned from the ramp-up phase to nameplate production as of just recently. I think this year, July, was then the commercial production.
Yep.
Can you tell us what that means for the company in facts and figures?
Make a lot of money.
Yeah, make money is good.
Yeah.
I'm a shareholder. I love that.
That's
When will
about
I
it,
see the
right?
dividend?
Well, soon-ish, right? We've hit nameplate now. We're in steady state production. We now turn to optimization. Even now we have all-in sustaining cash costs less than $10 an ounce. I think there's some movement on that as we start to get into a more mature operation. So that gives us a great margin. We're going to be a significant silver producer. We make 40 to 50,000 ounces of gold a year.
That's a nice waste to have, isn't it?
Yeah, nice on the side.
Yeah.
And then we make lead and zinc. Ultimately, we'll make copper. And so it's a wonderful asset. And we have a property that's about 7 kilometres wide, 16 kilometres long. And this asset we have, which is everyone touts world class. This is a world class asset.
Absolutely.
This is the highest grade silver producer on the planet.
Yeah.
We've explored 5% of the property. All right. When we came on the ground in 2003, our first hole was the discovery hole. And then we couldn't move away from that area because everything we drilled hit silver. And now we have a very unique situation here. Every geologist who goes to school, when they come out, they want to find the source. They want to find where the minerals came from. We're sitting on top of an upwelling zone. Very unique.
Yeah.
There's 2 or 3 more on the property. So, we have a wonderful asset. It's going to generate a lot of cash flow, hopefully good management bonuses. And then as we continue to explore, we hope to replicate the story. The cash flow from Juanicipio funds our exploration in Utah and Ontario, where we have 2 outstanding geological potential assets. Watch the space. It's going to be fun.
Absolutely. Yeah, and what a beautiful Hollywood problem. Each hole you drill, you find silver. Jesus Christ. It's really hard for you. I really can imagine that.
Yeah.
And also, but if you listen carefully, the first hole was drilled in 2003. What year do we have this year? 23. That's 20 years from the first hole to a real mine. Just keep that in mind, what I said at the beginning. John, the gold price was keeping up quite well against the rising interest rates whilst gold equities went through a tough period. How did the year work out for you on the company level?
Okay, so, I went to Toastmasters one time, and I was told whenever you do one of these, you start with a joke.
Okay.
So, Tara and I are very lucky. We have a 10-year-old daughter, and she has a great sense of humor. I don't necessarily have a good sense of humor. So I phoned her, and I said, I need a joke for tonight. She said, Dad, I'll call you back in 10 minutes. So remember, this is a 10-year-old's joke to her father. How do you fix a broken tomato? With tomato paste, of course. Anyway, let's have the question again.
Tough gold markets. The year was horrible so far for everybody. But how did the year work out for you on the company level?
Oh, we've had a great year, and I focus on our mine operation. I have no impact on interest rates. I have zero impact on gold. But what I can control are things like making sure our mining operation runs well. And I'm pleased to say it's running extremely well. And, yes, operating costs have gone up. Pre-COVID, I was telling people our all-in sustaining costs would be $11.50 per ounce. Well, today they're $14.50 per ounce. But fortunately, gold was $1,700 pre-COVID, and it's close to $2,000. So the margins are still the same. But what we really need is 2,500 gold to get things moving again.
Absolutely. Scott, you are a 40-year veteran, mining veteran in the nuclear energy industry. You are the former president of Cameco, one of the world's largest uranium producers. And you've held leadership positions in major uranium mining companies in various industry organizations. In a short summary, what exposure do Uranium Energy Corp and Uranium Royalty offer to investors?
Yeah, well, first of all, it's so great to see so many uranium investors out there, and how much you've had to persevere, and you've had to have patience. And I want to say thank you to all the UEC shareholders out there that believed in the vision and our idea of taking a small Texas startup company that Amir Adnani had a vision 16 years ago, and today we're the fastest growing uranium company in the world, with two production assets in the United States that are on the verge of restart and producing out of Texas and Wyoming. And we're making major inroads into Saskatchewan, Canada, which is the Saudi Arabia of our industry in terms of high-grade operations. But it really, it speaks to that vision of, we're in cyclical commodities. If you're in one of those commodities today that's in one of those long down cycles, don't get discouraged as an investor or a manager of these companies. Embrace the downturns. When you have the luxury of time, license, permit, drill things out. If you can acquire assets for 10 cents on the dollar, that's what we did during the long 12-year bear market in uranium. And so today, we feel that we've got these assets ready to go. The only thing outside of our control was the uranium price and the uranium market. And we've gone from being oversupplied, inventory-driven market to now an industry that's production-driven. We don't only need new production. We need 8 to 10 new mines coming on globally around the world between now and 2030. And as you know, it's not easy, quick, to bring on anything in this environment, certainly not uranium mines. So UEC gives you that direct exposure to new mine development in stable jurisdictions of Canada and the United States. Uranium Royalty is the capital provider to other companies like UEC. We want to come alongside the mines in Africa, Australia, Canada, the US, and provide them finance in exchange for royalties and streams, and put that into our portfolio and give all of you diversified exposure. To date, we have 20 royalty interests in 18 projects around the world. We basically want to take the Franco-Nevada wheat and precious metals model, and we've taken it to uranium. So we're very active trying to grow that portfolio. As a lot of new mines need to be built, we want to be the financier to a number of those.
And of course, benefit.
Yes.
Yes. George, which are currently the biggest consumers of silver, and how is the supply-demand situation in the physical market? Something I spoke already a bit about. We often hear there is actually a deficit in the physical market, which is?
Well, you said it. You said 5 years of deficit. I look at 2022, last year, right? The silver market had a deficit of 238 million ounces of silver. Ronnie's out there.
Yep.
I'm not an economist, I'm an engineer. But when you have 5 years of deficit, you have such a significant deficit last year, and the metal price goes down 14%. I don't understand that.
Same here.
As we go forward, the silver market is predicted to be in deficit for the foreseeable future. Again, I'm not an economist, but when I go to the supermarket and there's no milk or bread, when the milk or bread comes in, it costs more in the future than what I bought it yesterday for. That's not happening with silver. So I think institutional investors just don't care about the silver price right now. The warehousing of silver, the inventories has halved. Right? There's going to come a point in time, you want to buy a bar of silver, Johnny? You go and try and buy it, they open the door, there's nothing there. Silver has the potential to knee-jerk to some incredible heights. Mm-hmm. I don't know when that is. I hope it happens. But when you have all-in sustaining costs less than $10 an ounce, it's okay where we are, but I think it'll go up. So I really don't understand the silver market and how fundamentally it is in such a stress situation, and the metal price doesn't reflect that. Silver is produced mainly from byproduct. Like primary silver mines are less than 30% of the global annual silver production. The rest comes from lead zinc mines. A lot of those are closing down because they're running to the end of their mine life. Now, copper mines make a fair bit of silver, and there's a few gold mines that make silver. Silver, at best, the supply of silver will increase 3 to 4% per year for the next few years. Demand is forecast to increase 10 to 15%. So here's this deficit getting worse. The biggest use of silver is in electrical and electronics, power generation, power distribution, cell phones, all that stuff, right? The biggest one is photovoltaic. And photovoltaic is anticipated to increase, the use of silver in photovoltaic is anticipated to increase 55% over the next 10 years. The vaults are getting empty. Where does the silver come from? There's still a big demand for silver in the jewellery sector, in the silverware sector. And we've just been through COVID. Probably half the people in the room have a cough right now. Silver is a natural biocide. It breaks down the structure of bacteria cells. It kills them. It can do that within a mammalian body. It doesn't affect the host. We've had antibiotics since the 1950s. A lot of bacteria are now resistant to that. Everyone's eating off a silver spoon, silver fork, silver knife. Why? William III realised that to have good food, you have to eat it with silver.
Yes.
So there are so many aspects about the consumption of silver that are growing, but the production is not growing.
Just a short question in addition, but please a short answer.
I don't talk too much.
Yes, I talk to you. Has it already happened that, for example, solar producers called you and said, hey, you are now in full production. Can we buy 100,000 ounces silver per month from you just to make sure we get the delivery?
No, not yet. I'm sure people understand we're in a joint venture with Fresnillo. So we don't actually have access to the silver like other silver producers. So I think that sort of deters people from calling us. Short answer.
Okay, good. John, can you tell us a bit more about your strategy on growth at your producing Eagle Mine, but also regarding your recent acquisition of the Brewer deposit and the ongoing exploration campaign at Dublin Gulch?
Sure. Our focus is on Eagle. It's been a struggle getting it up and running properly. A lot of it COVID related, but we're finally there. We're generating good free cash flow. So now we can start to cast an eye about and look at other opportunities. You talked about recently we acquired the Yukon assets of a company called Sabre Gold. Now, this was a very opportunistic acquisition. I don't know if anybody knows Sabre Gold, but they made the ultimate mistake of a junior. They took on debt, thinking that, in the future they'd be able to raise money and pay back the debt. Well, it didn't happen. The debt holders said, hey, we want our money back. So they came to us and said, would you be interested in buying our Yukon assets? They're in our own backyard. We know permitting in the Yukon. We know heap leach mining. Brewery Creek is a former heap leach operation. A fellow I think probably many of you know, Bill Sheriff with Golden Predator, spent $56 million drilling off Brewery Creek. So there's over 2 million ounces of M&I reserve there. It's our intent to go back into the permitting process, permit it, probably take 3 or 4 years in the Yukon, and put a small mine back in production, producing 50 to 60,000 ounces per year for probably 10 to 12 years. So a nice little tuck-in for us. Along with that came a couple of exploration properties that we'll evaluate over the winter. And then the real key thing wasn't the reason we acquired it, but the Golden Predator had accumulated tax losses. So there's roughly 44 million in tax losses, of which about 11.5 million we can apply on Eagle earnings, so we don't pay taxes there. So
it pays for itself.
Net, it cost us nothing.
Exactly. Super. Scott, the uranium space had an impressive run, and I think this will move on, honestly. Is this uptrend sustainable, and what is different this time? I understand that nuclear power is one of the lowest carbon emitters, of course, but what about technological developments?
Yeah, well, I think a lot of you out there remember the last bull market, and a lot of money was made by investors in that bull market, where we went from uranium prices at around $10 a pound to $137 a pound. I think the conditions in this bull market are even better. The main difference being, even back then, we had the nuclear renaissance, plants were being built again, but we still had a large amount of inventories that had a buffering effect on how high the price could go, and it still went to 137. Well, today we have just as much of a nuclear renaissance, but with a difference. We now have the political right and the left agreeing that we need nuclear power in the mix. Republicans and Democrats in the US Congress don't agree on anything, but they agree on nuclear power. So what can happen, if we don't have half the world against us like we did back in the last bull cycle, but we have everybody pulling in the same direction? It's really been a realization that the green energy transition has not gone very well. I think the objective of producing cleaner, greener energy is a good and noble cause, and we should embrace it wholeheartedly. But it's got to be done with math and science, not ideology, not dreams of unicorns producing power. Wind and solar, I'm not against it, but it produces power 20-30% of the time. Nuclear power runs 24/7 and is as carbon-free and safe as wind and solar. So that realization has really driven this market. We have the structural deficit, 50 million pounds a year deficit between what we consume globally. The 438 reactors consume 200 million pounds a year. We've been producing at 50 to 70 million pounds less than that with the production discipline that came off the back of the last bear market cycle. If that wasn't enough, demand is now growing. We're expecting a doubling of nuclear power by 2040. And then layer on geopolitics and what's happening with Russia, Ukraine, the ambitious aspirations of China, political instability in West Central Africa, and you have a perfect storm of conditions where not only is the world in a deficit, but the Western world needs to build mines at a greater pace than the East. Our market's kind of dividing amongst Russia, China, and the BRICS in one camp, and the West, Europe, Australia, Canada, the US, and the other. I'm pretty sure the world's largest producer, Kazakhstan, goes in their camp, not ours. So that's 60 to 80 million pounds a year of the 140, 150 million pounds we're currently producing. We need to build a lot of more mines in places like Saskatchewan, Texas, Wyoming, and elsewhere to make up this gap. So people ask me, where are we in this cycle? If this is a baseball game, we're in the first inning. The conditions are such that this isn't just a short-lived flash and crash. It will take years for this structural deficit to be made up with new mines. We don't have the inventory buffer anymore. That's shocking to utilities. They fully understand that they're in a supply squeeze over at least the next 2 or 3 years, maybe longer, depending how quickly the industry can react. We're not as efficient a market as, say, copper, gold, and silver, where price signals like this would signal idle mines to come online almost real time to help moderate price increase. We need to build those new mines from scratch or restart them. This is where UEC has an advantage. We have mines that have operated at a $40 all-in cost. We've prepped them for restart, perhaps as early as next summer, and we're unhedged. This is a huge differentiator. Why would we sell all our production in terms that represent the last 3, 4, 5 years when we have the highest uranium prices that we've seen in history coming in this bull market? So low-cost, scalable production, good jurisdictions, and an unhedged book is a good combination. I think we're up 140% in our equity price since April, May of this year, which was coincidentally the military coup in Niger. I don't know if it's coincidental or what, but since that time, we've been the best performing uranium equity. And URC has been the best performing resource, royalty, and streaming stock. So I think we're on to something, but the uranium market's got a lot of legs under it. So you're not too late if you're not in, but don't wait too long.
I would say it's just the beginning.
Yeah.
George, with a producing mine in your portfolio, which is lovely, what are your next priorities which will generate value within MAG Silver for us shareholders?
Okay, well, we've proven since 2003 we're good at exploration. So a lot of our value creation going forward is exploration. But it's now exploration that we can fund from the cash flow from Juanicipio. So I mentioned earlier, Juanicipio itself, we got 95% of the property to explore. Deer Trail in Utah is got the potential to be a very prolific carbon replacement deposit sort of outcome for us with success. And then in Ontario, we sit on the Cadillac Lada break with no deep holes in there. And everyone knows in that area, you have to drill deep to get the good stuff. And so we're drilling the first deep holes in that now. So I think over time, cash flow from Juanicipio bolsters the balance sheet. We'll think about you as a shareholder.
Yeah, please.
We'll also fund, our exploration programs. And, in our business, the biggest lever on value creation for shareholders is discovery. And we believe we have 3 potential discovery areas. with Juanicipio, Deer Trail, and Larder.
yeah.
And the capital demands for that exploration program is far less than the amount of cash that we will generate. So we build a strong balance sheet. We look to allocate capital. I think everyone's going to be happy going forward.
Lovely. Glad to hear that.
Yep.
John, many gold producers have been able to defend good margins despite the cost inflation. The average of the analyst targets are significantly higher than your current share price, but somewhat the investment community seems absent in the market. What is your message to the audience in terms of value proposition? Just buy the stock.
I'm glad you got that question.
Well, I think, for Victoria, as I mentioned earlier, it's been a struggle through COVID, getting the mine up and running. Post-COVID had its continued challenges, but the mine is running now. We missed our guidance 3 years in a row. I don't know if there's any wood here, but I think we're going to make our guidance this year, and I think we have to do that this year and a couple more quarters next year, and then the market will reward us and our shareholders. But be patient. There's good things to come.
Mm-hmm. But you are still working on a project 250?
No, we've got to learn to walk before we run.
Good.
So we want to achieve 200,000 ounces per year. Certainly the deposit, could support a higher production rate, but it would require significant capital to do that. So, let's get steady state 200,000 ounces per year. Then we'll look at higher production rates.
Great. I like that. Be conservative. That's good. Scott, in today's world, it is very important to understand that the geopolitical aspects involved with mining uranium and where the major suppliers, but also the major consumers are based. Can you share some more insights with us, please?
Yeah, well, we touched on it a little bit, and that the uranium market is really bifurcating into two worlds. I think the Russian invasion of Ukraine was a wake-up call for us in a lot of ways. In the U.S., we generate 20% of our electricity from nuclear power. 1 in 5 homes gets their power from nuclear. Yet 50% of the uranium used to power that comes from Russia, Kazakhstan, and Uzbekistan. And I think, listen, we all believe in global trade. My degree in university was international business. But I think through this experience, and even COVID to some degree, where we relied on China for pharmaceuticals, medical equipment, and maybe we've kind of fallen under the trap in rare earth minerals, critical minerals, energy dependence, we learned that some things are too important to outsource to especially countries that don't share our values or interests. The West, Europe, Australia, Canada, the United States, we can stick together and rely on each other. But I think you have a situation where you really don't want to be relying on supplies that are controlled or encumbered by Russia and China. I mean, with China, it's really just they're a formidable competitor. In a way, they're going after their uranium needs and other mineral needs in a very aggressive manner. That is true whether or not they invade Taiwan and things get really complicated. But we've seen the vulnerability of Russia. We've seen West Central Africa with Niger. Small country in West Africa supplies 24% of the uranium to the European Union, mainly France. So stable jurisdictions, pro-mining jurisdictions, where you're welcomed and wanted is the place to be building and operating mines these days. And again, it was part of our strategy. We never thought the U.S. that consumes 50 million pounds a year should be relying close to 100% of their uranium requirements from foreign sources. We're okay with Australia and Canada, but Russia, Kazakhstan, Uzbekistan is a different story. So the same can be true in Europe. France relies heavily on the Niger uranium, but also Kazakhstan. The Chinese and Russians are very quickly consolidating their control over the world's largest producer. Russia controls half of that country's output, and the Chinese are rapidly consolidating the other half through direct ownership in mines, through very large contracts, and some logistical situation where they've established a global trading hub in China across the border from Kazakhstan. That's just a very clever way to get more uranium going into China and not to Russia, US, Europe. So the point here being, why did Macron travel to Kazakhstan and Uzbekistan last week? Is to reinforce their ownership interests in those mines because they feel that heat from Russia and China. So again, we're happy to be in stable jurisdictions like North America, Texas, Wyoming, Saskatchewan. But I think the West, needs to look after Western needs. So, I'm confident that the industry can respond to that. But it's taken a while here. We had no uranium mine development for years, and now we need it happening a lot and tomorrow. So exciting times for uranium investors. Look for those mines and those producers that have assets that can produce and cash flow in this cycle. Or if they're a major longer cycle producer, their business model really advances. And that's where Uranium Royalty is really looking at that broader group, the broader cohort of uranium producers, miners, and developers. So if you want that pure exposure in uranium mining in North America, UEC probably has the best torque in the business to the story. If you want a diversified approach and have a global investment in multiple mines around the world, Uranium Royalty is a great way to approach the market.
Super. Before we come to the Q&A, I have for each of you a short question. I want to have a real short answer. George, is silver the new uranium? If we look at deficits, the market looks to me the same like uranium was the last years. Could you imagine that we see such an, I would call it, slight starting explosion, what we've seen this year in uranium? Could that happen next year in silver already?
No, I think uranium is the new silver because I think the silver market has been in deficit for so long. And I think it's more difficult to have the uranium market affected like you can on the silver market in terms of forward contracts and stores and etc. like that. I think we're peas in the pod. I think we're both in awesome positions in terms of the global supply. Long answer.
Yeah. Your structural deficits really resonated with me because, in a world of supply and demand, structural deficits, you can't argue with it. We're not using less commodities going forward. It's not being mined, and the demand is there.
It ends up in the same place.
Yeah.
Hang on for the ride.
Yeah.
Exactly.
Correct, Ronnie? He's the economist. When you have supply demand like that, price goes like that. It's just when. Yeah. It's hard to know when.
Yeah, absolutely. John, short question on the gold price, because it seems to me a little bit not understandable why gold is not already at $2,500 or $3,000 with those inflation rates on the one hand. But on the other hand, we see central banks buying like not we have seen for the last 50, 60 years, especially China, but also Turkey, Venezuela, Poland, the BRIC states. Why do you think we are not yet there? And what is your personal view, not the company view, your personal view, please? I don't want to get you in trouble. When will we see the 2,500 plus?
Well, I often get asked, you're the CEO, where do you think gold prices are going? And, my cocky answer is if I knew, I'd be on a beach somewhere.
Yeah.
I wouldn't be doing this, working, 20 hours a day, 7 days a week. But I'm a gold bull, my wife and I, we own physical gold, we own gold equities. So we're all in. And I think 2,500 is coming shortly.
Good, perfect. Last question also for you.
Yeah.
Because I remember when you have been the president of Cameco, you wrote the highest bill ever in the company. That was for £1 million at $138 per pound.
Correct.
And I think you have it framed in your office, if I'm correct.
One delivery.
Yeah, exactly. So there was a $138 million bill. When will we see uranium break 140? What's your feeling?
Listen, remember, uranium demand is inelastic. You run a nuclear power plant 24/7. It's baseload power. So you're not going to substitute coal in a nuclear power plant. And also remember that the price of uranium really doesn't impact the generating cost. For electricity from natural gas, the fuel, the gas, is 75% of the electricity generating cost. For nuclear, the uranium is 5 to 10%. So we could double, triple in the uranium price, and it will not show up in your electricity rates or your bill. So keep that in mind. If utilities need the uranium, they'll pay for it. Also remember that we don't have inventory buffers anymore. The production discipline, the physical buying by companies like Sprott Physical Uranium Trust, by Yellowcake, even Zuri-Invest, taking uranium off the market and sequestering it, has not only rebalanced the market, it's now thrown it into a severe deficit. So again, I think, if you could see that next year at the rate we're going, and for very good fundamental reasons: supply, demand, the green energy transition, and these geopolitics. The U.S. were on the verge of banning Russian uranium. It's about time. It's 2 years after the invasion of Ukraine. But that shows you how reliant the U.S. was on Russian uranium. We wanted to pass legislation to shore up our fuel cycle before we took that step. But Putin could cut us off tomorrow. And so, I think we get to $140 a pound even without some of those extreme measures, just the normal fundamentals.
Yeah. Okay, super. All right, so Patrick, Q&A. Oh, there's a question. The lady here, she was first, and then Raphael.
Thank you. I have a question for John. What do you think will it need to trigger this tremendous upswing of 25% to 2,500?
Well, I think you told me you own about 10% of your PA is in physical gold. I think you need to buy more. I don't think, as George talked about, silver is more supply and demand than gold, and silver has an industrial use, whereas gold is really, it's the intrinsic value it holds. And it doesn't take much buying by retails, bankers, to change the price of gold. And I think with what's going on in the world, people are going to wake up and buy more gold, and it's going to drive the price up.
Then Raphael?
Question about uranium. The Niger production, which is basically French production, is that changing hands? Are they taking it away and giving it to the Chinese, or can they take it away from them? Of course.
Well, sure they can. Yeah, it's
Will they?
Niger. It's hard to say. I mean, Orano is still present in the country, operating the mine. I think the mine is still operating at a reduced rate, but the mill has shut in because the reagents can't be imported, and uranium production can't be exported. So it's a good question. Obviously, they do not like the French there. Would a Canadian or American company have more welcoming presence in that country? Perhaps.
But you have this. They have more pull, I would say.
Yeah. No, we have I think one of the largest military drone bases that the U.S. has is based in Niger. So you wonder why they've been a little muted in terms of the military coup. It's self-interest. But, I mean, it impacts not only the existing French mine, but you also have 2 or 3 mines under development that we're hoping are part of this next wave of new mine development. So Niger, for a small country, actually has a real outsized impact on what happens in the uranium market.
Question to George. The rising energy prices, the rising labor prices, how many of your competition of gold and silver mines are going to be shut down because they are no longer profitable, which will also decrease the supply?
I always have a policy not to talk about my fellow miners, but there are a lot of producers. I'll only talk about silver, Raphael. There are a lot of silver producers out there that have all-in sustaining cash costs $17, $18, $19 an ounce. They're close, right? And at $21, $22 silver, they're only trading dollars. So if silver was to dip or inflationary pressures come on, I think there are a number of silver mines out there that are going to find some pretty severe financial stress. So I think the silver price will get a lot of those operations out of trouble, because I do believe the silver price will go up. But the average production costs in the industry aren't where we are at $9 and going lower. They're closer to 20. So it's a tough business for a lot of silver miners.
Okay.
Except
Pascal?
for MAG.
Yeah, Pascal?
So how interest rates affect the uranium royalty business, and are rising rates actually positive for URC?
We're a competitor for cost of capital for miners and developers. So we compete against equity. We compete against debt. What's nice of the royalty and stream model, it doesn't dilute with issuing new shares, and a lot of companies in our sector have had to survive pretty long, prolonged bear market. Interest rates being where they are make a royalty and stream pretty competitive as well. So, it helps us. Listen, I think our industry is going to need probably $4 billion of investment in the coming years to build those 8 to 10 mines. We just need to capture a small portion of that in royalties and streams. There'll be debt equity financings as well. And in many cases, we may partner with other players to provide a package deal that has elements of all those things. We're trying to kind of come up with some creative structured financing packages that really kind of tick the box for miners and developers.
I had a question. Are you hedged on the uranium price deck, or what's your outlook for the uranium price deck going into the future?
Is UEC hedged?
Yeah.
Absolutely unhedged. We're very unique in that regard, in that, again, I spent 40 years in the uranium industry as a utility fuel buyer. I bought uranium for a nuclear power plant. I've been with 3 of the 4 largest uranium mining companies in the world, leading global uranium marketing. And one thing I've learned at this stage of a bull market is it's not my job to hedge the utilities' upside risk. They have people in their organization that can take steps to do that. My job is to get all of you the highest possible selling price I can for our production. That's very valuable. That what it takes to explore, discover, develop, mine, and get uranium to market is a real blessing when you surpass all those hurdles and you're successful. The last thing I want to do is hedge away the upside with prices that represent the last 5 years and not the next 5 years. So we can do that. We're not building $2 billion underground mines and milling complexes. These are ISR mines that are more like oil and gas drilling. So we're more flexible. If our price projections are right, we can increase production quite incrementally. If we're wrong, we can scale back, but we don't have huge standby costs. So we're happy to take that risk and capture all of you 100% of the upside.
Yep, please.
What will have to happen that silver price manipulations will stop?
George, that's for you.
I wish I could answer that. I think at the end of the day, when John goes to get his bar of silver and it's not in the safe, all that's off, right? There's going to come a point in time very soon, I believe, where there will be no physical silver. You can't manipulate that, right? People are going to want silver. People need silver. People need the next generation of iPhone, right? People want more photovoltaic cells. If the silver's not there, the price goes up. And we're close to that. So, I don't know. I think everything's manipulated in the world. My kids manipulate me. And I just think at the end of the day, the fundamentals will ring true. And I think the day of reckoning for the silver price is close.
Yep. Patrick here.
Pascal.
So I think there is from Jeffrey Christian, he basically says it's no deficit of silver because you cannot count the investment demand because it's still there, just it lays in another vault. So is a lot of silver available. What do you say to this argument that there is no silver deficit because it's just investors' silver laying there?
I thought you'd give me a softer question, Pascal, given you're going to Australia for 3 months and you want to have a good time. But anyway, in 2005, I went to a secret place in London where there are massive underground silver, gold, platinum storage facilities. And these vaults were packed with metal. 2005. I went there in 2018. There were no silver bars in that, which looked like there were square metres of silver bars from the roof to the ceiling. They're not there, right? So I know what Jeffrey's saying. Jochen said the known stocks of silver have gone from 1.4 billion ounces to 700 million. 700 million ounces of silver in known stocks is 60% of the global production in 1 year. We're going to run out of silver very quickly.
Oh, yeah.
Right?
So,
be a new silver mine starting up with one of the highest grade silver projects in the world. Good place to be. And MAG's on sale now. Buy now.
Yeah. Perfect. So I do not see more. Well, then, George, John, Scott, thank you very much for the panel.
Always good.
Pleasure.
Well done, Johnny.